All right, all set.
Okay. Good morning, everybody. I suddenly realized this is actually our last meeting of this year, 2024, our last full board meeting, and we've accomplished quite a bit this year. It's been quite remarkable, so we have a lot to be proud of. First item of business, let's see, I'm calling this meeting to order at 9:02 a.m. on Friday, December 13th, which we've decided to say is a very lucky day for us. First order of business, do I hear any public comments or questions? No, so let's go to the consent agenda. Brian, did you want to talk about that?
Real quick, thank you. We've got our meeting minutes from the October 25th, 2024 board in the packet that we'll seek a resolution on. And then we provided a few materials as just general updates. Our under 500,000 and no more in aggregate than $1 million staff approved transactions that are consistent with our comprehensive plan and budget. We've got 2 CPACE projects coming through that. As you'll see from today's agenda, CPACE is off and running, and the team are really in communities across the state. So we had a project in East Granby and New Britain. We also included our Q1 FY25 financial report that we sent out, I think at the end of November, early part of December. So we just included that in the packet, as well as our Inclusive Prosperity Capital Q1 FY25 financial report. So with that, I would ask that resolution number 1 be moved.
Okay, do I hear a motion to approve the consent agenda?
So moved. John
Second.
Hardy.
Okay. All in favor?
Aye.
Aye.
Aye. Opposed? Abstaining? Okay. Moving on. The next item, we're going to talk about financing programs, and I think Mackie Dykes.
Yes, thank you,
Yes.
Chair Reed.
Hi.
Good morning. This is Mackie Dykes, the financing programs team. As Brian just said, I think he said up and running, or so. A lot of CPACE coming through. We were all meeting yesterday, just going through all the projects and counted up, and we've got nearly 20 projects that have approval or are in the various stages of actually closing on their financing agreement. We hope to add 4 more to that queue here today. And then we've got a number that are in underwriting that should be making their way to approval at the beginning of next year. So we couldn't remember a time actually when we had this many projects in those, sort of end of the pipeline. The closest we could come to for the longtime board members will remember when we did the car dealership deal with Green Earth Energy back in the early to mid 2010s. That was the closest I think we ever came to this level of volume. But appreciate the attention from the board and deployment committee on these, and also all the folks doing all the hard work on getting these to close. So with that said, let me turn it over to Catherine Duncan to walk us through our first project.
You may be on mute.
Catherine
Yeah, you're
Duncan?
muted.
Yep, sorry, I was on mute. I apologize.
Okay.
All right. The first project we're looking at this morning is 242 Branford Road. It's the third of 4 related transactions by Bobby Massey, who is a business owner, a property owner, and he works with U.S. Green Technologies to build these projects on buildings he owns. So next slide, please. Right, so it's an industrial project, and they're putting on almost 300 kilowatt solar system, and there is a roof along with this project. There's a sole tenant occupying the space for the last 17 years, Stony Creek Holdings. And let's go to the next slide, please. The benefit assessment will be for the pretty standard 20 years at our 5.75% rate. I don't know if David Beach is on the call. David, are you here? Do you want to speak to the financial metrics or? No, I don't think he's
Not
here.
see
So,
David on.
pardon?
No, David is not on.
Okay, so the loan to value is very close to, you know, our max. The lean to value is a little bit higher, and the DSCR is a very solid almost 1.6, which is much higher than our required 1.2. The mortgage lender is Essex Savings Bank, and we have verbal consent. We're waiting on the written consent from them. The SIR is 1.08. You can see the savings both over the lifetime and annual on the slide. So next slide, please. Is it possible to make that bigger for folks? I don't know if people can see that well enough, but this is one of those deals with the addition of a roof where the normal cash flow is positive overall, but generally negative on a year-by-year basis after year one. So we have presented the sculpted amortization schedule, which will be the next slide, please. And you can see that the annual SIR is in every year, but the inverter replacement year, it's above 1. And in this instance, the owner has opted to go with the sculpted amortization schedule. So this is the schedule he's chosen. And that's our last slide on this transaction. Does anyone have questions?
I had a question. You said this is John Harity. You said it's a manufacturer. What do they make?
No, I didn't say it's a manufacturer. I said it's an industrial building.
Oh,
Stony
okay. Well, excuse me. What's the activity in the building then?
So Stony Creek Holdings, I believe, is the parent company of they make and sell artisan things. Hang on, I'm gonna have to go to the memo to read you exactly what it is they do. Hang on. I know it's in here, just a sec. Okay, so the tenant is a subsidiary of Stony Creek Brands, which operates a national e-commerce and catalog company. They sell handcrafted items from artisans, including jewelry, clothing, home decor, pottery, and glass products.
All right. So they're like they house a computer based selling company then, right?
E-commerce, yeah.
Yeah. Okay. Thank you.
Yep. Any other questions? No? Shall we move to the resolution?
Sure. Do I hear a motion to approve resolution number 2?
I'll make that motion, Jody Nicola.
Oh, thank you. Do I hear a second?
Second.
Oh.
Allison, was that you?
Yeah.
Thank you very much. Okay, all in favor?
Aye.
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 Opposed? Abstaining?
Brenda's abstaining as I just joined.
Okay. Hi, Brenda.
Hi, everybody.
All right. So moving on to our next item.
Okay, that's me again.
Yeah, that's what I thought.
So this is the fourth project that came to us from Bobby Massey and US Green Technologies at 12 Branford Street, also in the town of Branford. This next slide, please. So again, an industrial property, it's got one tenant. The tenant is Cintas Corporation, and Cintas Corporation is a company that provides products and services to help customers, this is a quote, get ready for the workday, including uniforms, floor care, restroom supplies, first aid and safety products, fire extinguishers, etc. So Cintas has been there for about 10 years. I think the lease, there's another, 3 years on that lease. This is a roof and solar again, 300 kilowatts about. Next slide, please. So 925 is the benefit assessment for 20 years at our standard 5.75%. The loan to value is quite healthy, given our ratios. The lean to value, again, a little bit more, and the DSCR is very healthy at 2.42. You can see the savings, annual and lifetime, and with the roof, it's a SIR of 1.09. Next slide, please. You'll be very familiar with this now. I don't know if it's big enough for folks to see again. If not, maybe someone can make that big or small on my screen. So normal cash flows are, below 1 annually, so it's carried by the first year. So we showed the sculpted, if you'll go to slide 2. Yep. Okay. So you can see that sculpted, other than the year where he does the bullet payment, and again, the year where inverters are assumed to be replaced, it goes to a positive annual SIR, which again, in this case, he's chosen to use the sculpted amortization schedule. So any questions about this project? If not, then could we move to the resolutions, please?
Do I hear a motion to approve Resolution 3?
I'll make the motion. Joanna Wozniak-Brown.
Oh, thank you, Joanna. Do we hear a second?
I'll second. Adrian speaking.
Thank you, Adrian. All in favor?
Aye.
Aye. Opposed? Abstaining? Okay. Moving on.
All right, and we're going to turn it over to Elise Buzzelli for these final 2 CPACE projects.
Okay. Hello, Elise.
Hello, Chair Reed. Hello, everybody. Good morning. So we have another CPACE transaction. This one is in New Britain. And this is for 410 John Downey Associates. This is an industrial facility. There's a single tenant here. They're a manufacturer called Northeast Metal Works, and they provide metal finishing and metal stamping services. This project is being built, it's a combination roof and ground mount, being built by Facility Solutions Group, who used to be Green Leaf. We've done quite a few projects with Green Leaf, and Facility Solutions Group purchased that organization about a year ago. And on the next slide here, so we're looking at a $775,000 benefit assessment for 20 years at our standard 2.75 rate. And I will turn it over here to Louise Della Pesca to talk about the financial metrics. Louise?
Thank you, Elise. So the financial metrics for this transaction, the property is valued at $1.7 million. What that means is the loan to value ratio is 80.8%, and that's very slightly above the standard underwriting metrics that we use. So the threshold for the standard metrics would be 80%. So this is almost 1% higher. The lean to value is also slightly higher. It's 44.6. The threshold is 35%. So what that means is we put forward reasons why this should be approved on an exception basis. The reasons for that are the existence of a long-term revenue contract with an investment grade counterparty. So that refers to the tariff that's in place between the property owner and the utility in order to sell the solar power that's being generated. That's a 20-year contract. That's a credit positive, as is the fact that we actually modeled, in order to arrive at a forecast DSCR of 1.55, we actually modeled that quite conservatively. If you were to take out some of the conservative modeling, for example, the management fee, which is quite arbitrarily charged in this case to the to the property company. So if you were taking out the conservative modeling, that DSCR would be 1.9, which exceeds the 1.75 that allows for exceptions in this case. The lean to value at 44.6 is also a lot lower than what the upper threshold would be to allow for exception-based approvals, which is 65%. So taking all those factors into consideration and also obtaining mortgage lender consent to that, that's why we're putting forward this deal for approval. Thank you. Back to you, Elise.
Great, thank you so much, Louise. And then looking at the energy metrics here, we've got an SIR of 1.16 with lifetime savings of just over 1.2 million. So if we can go to the next slide. Same thing here as Catherine's previous two. There's a roof in this one. I think I failed to mention that on the first slide, but there is a roof upgrade here. So we presented both the standard cash flow, which is what you're seeing here, as well as a sculpted option. We presented both of those to the property owner, and he chose to use the standard option, which is the one you're seeing here. And the next slide shows you the sculpted option.
Quick question.
Sure.
I'm sorry, is it okay to ask?
Of course.
In the previous slide, it notes 5.75 as the interest rate. Is it 5.75 or 2.75?
5.75. Yep, that's our standard interest rate for a 20-year term for projects that are over 500,000.
Gotcha. Thank you.
You're welcome.
I have a question. In the as the years go by, is there taken into account like an increase in what regular fuel costs would be for the company if they had not done this project? In other words, energy costs are going to rise over 20 years. So is that taken into account in the 1.2 million that they save, or not?
Yes, so when we do our technical underwriting, we incorporate an annual escalator, an average annual escalator for energy costs to increase. We use 2.99%, which is an average, I want to say over the last 30 years, that DNV, our technical administration partner, will occasionally, double check, make sure that's still, what the average is. But yes, that's what we use for our standard technical underwriting.
Well, I'm going to make the wild prediction that energy costs will go up more than 2% in the outlying years.
I think you might be right. It might be possible.
Yeah, it's a good point that we try to be conservative with our assumptions, because we're underwriting these large loans. And we've got a lot of discussion oftentimes about the cash flows being right on the edge. But you're right, I mean, these are all assumptions, and we're conservative, so it is likely that the savings will actually be a lot more.
Which just means that it will be a much better deal for anybody who does this. So, yeah. I mean, it's a real attractive deal to begin with. But when you think about that, it makes it literally a no-brainer to do this. So, thank you.
Welcome.
So we're ready for resolution number 4. Any more questions or concerns? Do I hear a motion to approve resolution 4?
So moved, John Harity.
Do I hear a second?
Second, Joe.
Second.
Okay, we have 2 seconds. Thank you.
Third.
That's good. I like that. I like that. Okay, all in favor?
Aye.
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 Opposed? Abstaining? Okay. Moving on. Is that
All right.
Elise as well?
It's me as well. Yes.
Okay.
Can't get rid of me yet. So this is another C-based transaction in Enfield. This is a project, commercial property. The property owner is Moody 157 LLC, but the operating company is Turf Products. Turf Products is a landscape and service company. They represent Toro products for landscaping and irrigation. And they do that for golf courses, municipalities, schools, etc. Been around since 1970. This is a carport project, and Green Earth Roofing Solutions is doing the installation. So for the loan, we're looking at a $1.08 million loan for a 20-year term, again at the standard 5.75 interest rate. And as I mentioned, this is a carport project. So the costs for a carport project tend to be quite a bit higher than a roof-mounted system. Of course, there's additional infrastructure and things that need to be built. You need to actually build the structure for the solar to go on. Plus, there's usually additional costs that come along with, having to rip up parts of the asphalt and put in those structures as well. So the costs are a little bit higher when we're looking at carport projects. And for this next vertical here, I will turn it over to Larry Campana for the financial metrics.
Terrific.
Larry, are you there? Great.
Yep. Hi. Thanks, Elise. I need to mention, if it impresses anyone, that Turf Products, the underlying operating company, is the provider of landscaping equipment for the Boston Red Sox and the U.S. Open. So if that impresses anyone,
what about the Yankees?
No, they didn't make it.
Uh-oh.
they probably use like gold-plated.
And all their money elsewhere, we know.
Yeah,
so.
Yeah, that's right.
Does this mean we'll be able to get tickets?
Yeah, I don't think so. But it is notable that it is a healthy sized underlying operating company, tens of millions of dollars, and that the company that we underwrote, 157 Moody, the property owner has common ownership, and it's basically just an entity set up to be the landlord, for the common ownership entity, Turf Products. That's why the DSCR is a modest DSCR of 1.32. If the underlying operating company is a sizable business, is my point. And also notable on this project is the property value. This was pre-approved 1 year ago with a lower property value from the municipal appraisal, which didn't reflect a sizable expansion that was done several years ago. So they did a private appraisal that reflected the entire size of the building, 87,000 square feet, and we came up with this new property value, almost $8 million. So that's notable as well, that we worked with the property owner to get that private appraisal that more accurately represents the value of the property. So all of the metrics are within guidelines and even below, which is great to see. That's all.
Great. Thank you, Larry. So moving on to the energy metrics here, SIR is just above 1 for this project at 1.01, and the savings over the lifetime are just over 1.8 million. So if we go to the next slide, once again, similar situation here with cash flows. And actually, in this situation, because of the cost of the carport, and there were also some additional electrical components that needed to be included to make the solar work, that of course don't have any energy savings associated with them. So in this case, we weren't able to cover 100% of the costs at the 20-year standard term. So what you're seeing here are the cash flows for about 88% of the project costs, is what we were able to cover and still meet a positive SIR calculation. So we showed the property owner, again, the standard amortization schedule, which you're seeing here, as well as a sculpted. You'll also note in the memo that Larry prepared, we also presented a 14-year term to the property owner. At a 14-year term, they're paying less interest, and therefore we were able to get them to 100% financing. So we kind of figured out where could we loan, what maximum loan term could we offer them while offering them 100%. And same thing there, we showed them both a standard and a sculpted. So Larry was very busy putting together a lot of different options for the property owner here. Ultimately, they chose to do the option that you're seeing now, or sorry, the standard option, which is on this. Yep, there we go. To do the standard option at the 20-year term. So put in a little bit of owner equity and take the standard approach.
And Elise, John has a question about if
sure.
there's an electric vehicle charging station, and no, there's not, is there?
No, there isn't yet. I don't know if that's something that they are planning to add. This project, when it first came through, I think that was when there was a pause on the incentives for a little while, but certainly something we can bring up to the property owner as we continue to talk with them about this project.
I have, this is Jody Nicole. I have one other question. Is it correct that the infrastructure for the carport also qualifies for ITC and the electrical upgrades, or what's in and what's out for the ITC?
Yes, the structure would qualify. That's all part of the system. You know, all of that combined would be part of that. The electrical components, I imagine, would be as well. Mackie, I don't know if you know that a little bit better, but my assumption is yes, that would be included.
Yeah, I don't know exactly what the electrical components are in this one, but generally, especially with the IRA expansion of ITC eligibility to interconnection cost, pretty safe to say that associated costs like that are ITC-able.
I like that term. Thank you.
Okay, do I hear a motion to approve Resolution 5?
I'll make the motion, Joe.
Thank you, Joe. Do we hear a second?
I'll second,
Second.
Joanna.
Okay, thank you. All in favor?
Aye.
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 Aye. Opposed? Abstaining? Okay.
And I'm sorry, Chair Reed, real quick before we move off financing programs, I'd like to flag the two just because of I think the community significance. I want to make sure the board's aware. The two projects that we did through the consent agenda. One of them was with Brignole Vineyards, which is a fairly prominent vineyard in the state, and also if there are any Hartford athletic fans here, they're a very prominent sponsor of Hartford soccer team. And the second project was with the New Britain Museum of Art, which I'm sure everyone's very familiar with. Very prominent cultural icon in the state. It's a dehumidification energy efficiency upgrade there. So again, just wanted to make sure as you're going about your lives in the community here, know that the Green Bank was involved with those two institutions, especially the Museum of Art.
That's great.
Actually, New Britain Museum is actually a humidification project. I keep messing that up, but it is humidification. They're adding humidity to, I'm assuming, to keep the paintings nice and fresh.
But so there's no peeling and chipping. Yeah,
That's my assumption. Yeah, we'll have to visit and check it out.
They have some priceless things there, so this sounds like a very good project.
Yep, we're excited to do it.
Madam Chair, I just had a comment on that. Is that this is John Harity. That first of all, New Britain Museum of Art is a wonderful place, and I recommend anybody that has not been there to go visit, because they always have remarkable temporary exhibits, and then their permanent collection is terrific. But that leads me to the second point, that it would be great in the lobby somewhere that there be some sort of signage, like a plaque, something that looks as classy as the museum itself, that says that the Green Bank has been involved in helping them preserve the art, or however we want to phrase it, because they have thousands of visitors from across the state and beyond the state, and really it'd be a wonderful place to just toot our horn a bit. So I hope if you could work that out, that would be great.
Yeah, I think they have a lot of paintings from the Hudson River School too. I mean, they have. There's a lot going on there that we should put our label on.
Yeah, that's a great idea. We'll be certain to work with our marketing team to see. I'm sure we'll do some a press release, and but yeah, something along those lines, or maybe even some sort of a ribbon cutting or event that we could host there is always something we like to do if we can. So certainly take that suggestion.
Great. Okay. So we're moving on to investment programs, and that sounds very much like Bert Hunter. Are you there, Bert?
Sorry. Was trying to get to my mute button. Apologies, Chair Reed. Actually, this is the Down East transaction, and Larry Campana is going to present. Larry.
Oh, Larry. Okay, great.
Terrific. Thanks, Chair Reed. Thank you, Bert. Presenting on Down East. This is a transaction modification. We brought this to the board almost a year to the day ago. First, I'd like to welcome, and he's not planning on speaking, but I do just want to recognize that the CEO of Monhegan Capital Management that manages the family trust that owns this group of companies, Phil Thompson, has joined us to listen in to our meeting today. So I wanted to thank him for joining and welcome him. So thank you, Phil, who's been a great partner with us over the course of the last year as this project has been being developed. So 1 year ago, we brought this to the board, and the board approved a $10 million transaction with MVCP LLC as the borrower. We had originally contemplated having this parent company be the borrower, and the underlying SVPs, special purpose SPVs, special purpose vehicles, being underneath it, and then owning all of the assets. We did that for a couple of reasons. We thought it would be streamlined. We thought it would be easier, and there's also the complexity of an opportunity zone project that is in this portfolio of companies. After working with our internal counsel and our outside counsel, we determined that structure would not work. It would be unnecessarily, prohibitively complicated for reporting and to structure the loans. So we have decided to instead of having the borrower be at the top level, the MVCP, that there'll be two borrowers, Down East Renewable Energy, and then the Down East entity that will be in the opportunity zone. So our counsel has advised this, as well as our outside counsel. And then the MVCP that was originally the borrower will now be the guarantor. This is our more traditional structure that we have for third-party owned solar portfolio. So this is more aligned with what the Connecticut Green Bank typically does. And now that we have this, this would be more in line, and everyone's basically signed off on it. It will be an easier structure for this group of projects. The other significant change that has happened over the course of the last year is we originally requested $10 million, and now we've revised it to $6 million. So first of all, we do believe that there will be $10 million in total projects and more than that over time. But over the course of the last year, some projects have moved forward, and we just have a better understanding of what projects are actually going to be operating, within the course of the next 6 to 12 months. So while we do believe that all the projects that we originally asked for will get built and there'll be debt on them, we do not think they will be built and get debt on them in the next in the very near future. So what we recommend now is only taking the $6 million for the 19 projects that are really teed up and ready to go. And then we'll either expand the facility or ask for a new facility in the future when the remainder of the projects are ready. So these are the two significant changes. If you can go to the next slide. Questions.
Any questions or concerns?
I'll just say it's not often that investments ask for less money, but one of those rare opportunities where we do. I also want to point out, it was mentioned, and Larry kind of mentioned that the opportunity zone that the sponsor is taking advantage of. This marks the first transaction. I think the opportunity zone financing program has been available for about maybe 4 years or something like that. This is the very first time we've actually been able to take advantage of it in a structure, or our sponsor has been able to take advantage of it. So it's quite exciting for us. Thanks. Back to you, Chair Reed.
Great.
I had a based on Bert. This is John Harity. Based on what you said, Bert, why do you think it's been 4 years? Is the program not well advertised, or is it a complex kind of apparatus, or what?
Yes, it is. It is the complexity. It's a mechanism where high net worth individuals can defer capital gains taxes, through it's a complicated structure, and typically it is reserved for, it's more applicable to low, moderate, and also all kinds of real estate. So either multifamily or commercial real estate. You see it quite often there, but it's much more rare in the renewables space, just because of the complexity of getting all the pieces to line up in the structure.
Well, as the billionaires multiply in our state, I hope that we're in contact with them.
Good idea. Good thought there, John.
Any more observations? Do I hear a motion to approve Resolution 6?
Motion to approve. This is Brenda.
Thank you. Thank you. Do I hear a second?
Second, this is Alton.
Thank you, Allison. All in favor?
Aye.
Aye. Opposed? Abstaining? Great. Moving on. Larry, are you going to do Raise Green too, or Bert?
No, that's going to be David Beach.
David Beach. Oh,
David,
good.
Are you?
Yeah,
Are you
I'm
there?
here, ready. Thank you,
Great.
Chair
Okay,
Reed.
great. Over to
Take
David.
it away, David.
I will, thank you. Yeah, I am excited to share today about new and exciting development for our Green Liberty Note program. We can go ahead and go to the next slide. So just a couple weeks ago, Raise Green, who's been our partner on the Green Liberty Note program for a little over 3 years, was acquired by another crowdfunding platform called Honeycomb Credit. And we've been in having discussions with Raise Green as they've been going through this acquisition process, and Honeycomb was able to submit an RFP into our Capital Solutions program, which is how we originally started working with Raise Green. And so today I'm going to walk through their updated Capital Solutions program and requesting approval for us to continue our Green Liberty Note program with this new combined entity. So I wanted to highlight a couple exciting things from this announcement. Jackie Logan, who is one of the founders of Raise Green and has also been our primary point of contact at the Green Bank, said that they can now combine local small business funding with investments focused on sustainability and climate action. Honeycomb has been really focused on supporting local and community small businesses. And something that was very interesting in the research that they did was that they found that locally focused opportunities were ranked highest by their investors, but that was followed closely by climate-related initiatives. And that was a big part of the impetus for this acquisition, and offers a really unique opportunity for the Green Bank, because looking down to that last bullet, Honeycomb has over 20,000 investor accounts that have made over $31,000 of unique investments. To put that in a bit of context, Raise Green has about 3,500 total investors. So it's a much bigger platform in terms of audience. And that's really exciting because, as the bullet above noted, their investors are really interested in local businesses and sustainability projects, which fits perfectly with our Green Liberty Notes that are supported by the Small Business Energy Advantage program. So if we go to the next slide, I'll talk a little bit about what the mechanics of this will mean for our program. So the first issue is investor migration. Folks obviously have their Raise Green accounts where they've invested in Green Liberty Notes already. And so what's happening over the next couple of weeks is that the Honeycomb transition team is going to be establishing profiles for those investors on their platform. And then once complete, our existing investors will be able to receive an invitation, and they'll just go and log into their dashboard and create a new password. This is something that Honeycomb has had success doing in the past. And we've had a really good experience so far working with their transition team to be able to make this a smooth process. Unlike Raise Green, who had to outsource a lot of their back-end software and escrow type services, Honeycomb has their own internal tech team, which allows them to be a little bit more efficient and have a bit more of a smoother process. It also allows their issuers to have a bit more of a seamless process because they don't have to ask somebody else to find out what needs to be done. It's just working directly with the people who are able to actually make the changes and see what's going on the website. So it's an exciting opportunity. So what are some of the things that are staying the same? We'll keep issuing Green Liberty Notes based on the terms we've discussed previously and deciding the interest rates the way we have. Same thing goes for issuance frequency. We're still looking at that quarterly pattern. And all the offering documents are the same. It's a different platform, but the SEC requirements are the same. We have to do the Form C and some of those other related documents. Honeycomb puts them in a bit of a different package, but all the same component parts are there, and they also go to the SEC. Honeycomb also uses technology called Plaid. That's the same one that was used at Raise Green. And so that's how investors are able to submit and connect their bank account information securely. So that's really great because that means a more seamless transition for people who had saved their bank information with Raise Green when it transfers over. And they're also, we've briefed them on the Green Bank's allocation method. This is where when one of our offerings is oversubscribed, we prioritize Connecticut investors, those folks who've invested $1,000 or less, and anyone who's reinvesting with us. So we're able to protect the Green Liberty Notes for the people that we really made them for, which is the smaller retail investors who weren't able to invest in some of our other offerings like Green Liberty bonds because they didn't have $1,000 or a broker. So what's different? Well, we have a new platform with more investors. That's exciting. It just means more eyeballs to start off with seeing our offering. And so that means hopefully some more investments without any more marketing dollars on our end. As I said a couple minutes ago, they have their own internal tech team. And so they've built a really great repayment process. Currently, we are working with an outside escrow company, and they do charge for some of the repayment services. Honeycomb has their own internal platform and are able to cover are able to do that without charging their issuers. So repayment will be cheaper and a bit easier. One thing that is different is they are not currently accepting checks, which is one way that some of our investors have invested previously. It's a pretty small amount, usually 3 to 5 investors per issuance, but it does give some people some extra comfort. So that's a conversation that we're setting up to have with Honeycomb. They've been able to grow really well by being kind of quick and efficient. And so sometimes waiting multiple weeks for checks to get it run, to come in and track down and be cashed hasn't quite fit with their business model. But it sounds like they may be open to it. So that is something we're going to run down and trying to balance the benefits of Honeycomb's smooth process with also supporting our investors who are a little wary of paying over the internet. And so that is the high-level proposed structure. I will wait for some questions on the resolution slide.
Any questions, concerns? John Harity?
Sorry, it's so predictable. But so how do they market? Do they market this as a green investment, and how do they do that?
I'm sorry, the investment in Raise Green, or like how will they market our Green Liberty Notes?
Yeah, well, yeah, I mean, yes. How does that? How do they market the money that they're taking on in order to do this? It'll be through the same Liberty Notes marketing that we do now.
Yeah, so our marketing will stay the same. We reach out to our big investor list. We've also done some online advertising and sent out postcards as well, which has had a fair bit of success. Raise Green has always done marketing on their own. They reach out to their followers on LinkedIn and other social media sites, and then they put a banner and stuff on their own website. And so Honeycomb will do some of the same thing. They highlight their different issuers on their different social media platforms, and it'll be displayed prominently on their site as well, which has that large base of frequent investors.
John, I mean, I think this should be a larger platform that should reach more people. In terms of what happens on the Honeycomb side, our side will remain the same. We're expecting, or we're eager to grow what we do in terms of Green Liberty Note issuance just in general, but also in terms of marketing and making sure we're leveraging this tool as we're working with communities across Connecticut, both in terms of what we can do in terms of financing, but also in terms of giving them the opportunity to invest.
But their whatever marketing they do then extends the reach of all this to
Absolutely.
a wider market. So that's great.
Absolutely.
Okay, any more questions, concerns? Did I already get a motion to approve this?
So moved, John Harity.
Do I hear a second?
I'll second Adrian speaking.
Thank you, Adrian.
You're welcome.
Good to hear your voice. All in favor?
Aye.
Aye.
Aye. Opposed? Abstaining? Great. Okay. Moving on. David, are you doing Cargill Falls or is Bert doing Cargill Falls?
I'm not.
That'll be,
That would be me.
Mariana Tree.
Mariana Tree.
Oh, hi, how are you? Oh, good, good, good. Okay. Take it away.
Thank you. If you could go on to the next slide. This is just an update. We will not be providing any motion for a resolution today. And this is an update on the historic Cargill Falls Mill C-PACE loan and the restructured. We came back to the board about a year ago asking for a deferral of payment on this loan associated with some lead remediation and a change in property management that was happening at the property. And we told the board we would come back in a year to present a full loan restructure. Today, I'm going to provide an update and an update on when we expect to come back to the board on the restructure. From a building perspective and providing an update there, the Connecticut Housing Partners assumed management of the property in February of 2024 of this year, and they've been addressing tenant concerns and also the lead remediation, which was mandated by the EPA. The remediation was completed in October of this year, and since then, the property managers have been working to lease out those units that were vacant and that had remained vacant during remediation. To date, the property during the remediation period was about 50% vacant. It is now has an occupancy level of 82% as of November, with full leasing, excluding sort of 4 units that need some repairs associated with water intrusion, expected by early 2025. The hydro on site has been performing as expected. It generated more than 3,000 megawatt hours of electricity over the past year, which is consistent with the expectation and has led to the property enjoying over 200,000 in utility savings, 66,000 of excess electricity sales, and 290,000 in ZRAC revenue over the last year. From a loan restructuring progress, stabilization efforts are underway, but the 2025 budget and multi-year financial projection has not been finalized, and some of that is due to some cost estimates that are pending to comply with EPA compliance testing, and those are expected to be finalized within the next month, along with some costs associated with the hydro O&M, and both of those will inform the restructuring proposal. We expect to come back to the board in the January 24th meeting with what that comprehensive restructuring proposal will look like. And it will include sort of repayment of what's due to the Green Bank and Green Bank maintaining its first lien position. In the interim, there's a payment that is due January 1st of 2025, which will be sent to the property owner. There's a delinquency grace period that's granted until February 3, which will allow the board to review the restructure that we bring forward at the January board meeting, so that the property is able to sort of make that restructured payment before
that interim payment is delinquent. So that's the plan and the update. We just wanted to give the board a heads up of what will be coming in January and the reasons why we won't be presenting it today.
Any questions or observations? This is quite remarkable, 82% occupancy. I know it's had, I mean, to me, you know,
Yes.
this is one of those projects that where ideas meet reality, and the fact that we've stayed in there and we've, you know, gone to the table a million times and been dealing with real issues that happen with something that is it's such a remarkable project is really a testament to the fact that we don't just hand out money and walk away or whatever. I mean, we really have been all over it. So it's a pretty exciting project. Any questions or observations?
Chair Reed, before we go to observation, I do want to follow up on that comment. It also demonstrates how we can work together with other agencies, particularly Department of Housing. Been a very stalwart partner, helping to get this project right, and so we work with them. We work with the health. What is the health department agency? Not agency, but
it's NDDH, but I know that's their acronym, but I'm blanking. But it's the agency that has purview over sort of the any lead conditions in the Northeast.
Yeah, so it really was a joint effort.
Yeah, we're losing you. We're losing your bird.
I would say the property manager helped out. Dealing with the tenants and everything. So it's really been a good effort, and it still is the first and only CPACE financed hydro project in the country. So it's definitely starting to. I don't want to jinx anything, but it seems like we turned the corner. Anyway, back to you, Chair.
Madam Chair,
John, you were going to say something? Yeah.
I just wanted to say it also reminds me of the kid that stays into their 20s before they're able to get on their feet. And I'm glad that it seems that they are.
Yeah, we're definitely working on that, John. And I know part of what we heard very clearly from the board last time we came was, let's hope that the next time you come with a proposal for a structure is the last one. And that's what we're shooting for. And we didn't want to come to you with a proposal without incomplete information today. So we'd rather defer that until January so that we can hopefully comply with that message that we heard about it being sort of a long-term solution.
This is Matt Brunelli's favorite project. Update. I'll have to make sure that he hears the recording.
Anything else? So I think that concludes our public business. Brian Farnan, remind me, do I need to take a motion to go into a private session?
Yes, you do.
Okay.
And you could do it for personnel matters and other items that are confidential and not required by statute.
Okay, so do I hear a motion to approve an executive session to deal with personnel-related matters and trade secrets and commercial information given in confidence and yada, yada, yada? Do we hear a motion?
So motion.
Thank you. Do we hear a second?
I'll second.
Second.
Thank you. All in favor?
Aye.
Aye.
Opposed? Abstaining? Okay,
I just make a comment. I think we typically would state either the staff, anybody other than board members going into executive session. That's typically a FOIA matter, meaning typically would announce that, I think.
So to Bert's point on the personnel related matters, we'd ask that Eric Schrago, and myself, Brian Garcia, be present on the commercial information in confidence matters. I'd ask that Sarah Harari, Stephanie Cohane, Bert Hunter, Larry Campana, and Brian Farnan be present.
Kevin.
And Kevin Moss.
So should we handle the commercial information given in confidence first, and then we can leave, and then you can have the personnel matters with Eric after that, and I'll go through the participants, and if I see individuals that should not be in, I'll remove them if they do not drop off on their own accord.
It's okay that those who I stated are in executive session. That's too many mechanics of going in and out of technology.
I noticed that CTN is still on the line.
That's an example.
So, but that can't move into executive session, right?
Right.
Yeah.
So I'm requesting that CTN please drop off the line.
We'll give it a second for that as I work through the taking us off recording, and then we could remove them. Give 1 second. Stop recording and transcription. Are back.
Ryan, if you could just drop out of the presentation, go back in, we've updated resolution 10 with the language.
Okay, we're back.
I would just use the resolution revision that I put into the chat box. That might be easiest.
Great.
So do I hear a motion to approve resolution 8?
I'm sorry, did we make a motion to come out of executive session?
We did.
Yes, we did.
Okay, sorry for that. I was.
So
I just don't have that information recorded though.
You were asking for a resolution to.
We're clarifying language in the resolution 10, right?
Yes.
Okay, but right now, shouldn't we get 8 and 9 out of the way and then deal with 10?
I move to approve resolution 8.
Thank you. Do I hear a second?
Second.
Excellent. All in favor?
Aye.
Aye.
Opposed? Abstaining? Great. Moving on to resolution 9. Do I hear a motion to approve resolution 9?
Motion approved.
Thank you.
Brenda.
A second? Is there a second in there?
Second, John Hardy.
Thank you, John. Okay, all in favor?
Aye.
Aye.
Opposed? Abstaining? Okay, moving on to 10. Brian Farnan, do we need to move to clarify the language, or?
Yeah, I would just say that the individual who's making the motion for the resolution just say, and as amended to include such authorization is contingent upon staff presenting the proposed agreements to the chair and vice chair of the Green Bank Board of Directors for final approval.
Ryan, the language has been updated on this slide.
Oh, you're quick, Sarah. Yeah, you could just say as amended on the slide. And then
Okay,
we'll have that in the record. Perfect.
is it amended on the slide?
It is. So I move to approve resolution number 10 as amended on the slide.
Thank you. Do I hear a second?
Second, Adrian.
Thank you. All in favor?
Aye.
Aye.
Opposed? Abstaining? Excellent. So that really concludes our business for today. Do
Can I
hear?
just make
Oh.
an announcement?
Go ahead, here, John.
Sorry, that the Connecticut Roundtable on Climate and Jobs has been chosen as a anchor organization for a regional what's EJ? What does that stand for?
Environmental justice.
Environmental
Yes,
justice.
right. Sorry, I drew a blank. Senior moment. Environmental justice fund at the federal level. That's about about $60 million that will be administered, choosing grant applicants to the fund, to draw off of the fund. So it's a great moment for us as an organization, and look for ways that you can apply.
Congratulations, John.
Great job.
Thank you.
So you've already got that money?
Well, we don't have the money, but we have the agreement is in place. Yeah.
Okay. Okay, so dare I hear a motion to adjourn this meeting of the Connecticut Green Bank?
So moved.
A second?
Second.
All in favor?
Aye.
Aye.
Have a great holiday, everybody.
Happy holidays.
I make a motion that we all have a great holiday.
Bye-bye.